Welcome to the boardroom, a place where men in $3,000 suits sit around mahogany tables, sipping mineral water that costs more than your monthly rent, and making decisions that shape the very fabric of human history. We like to imagine these people are geniuses. We want to believe that to reach the top of a Fortune 500 company, you must possess a brain wired for complex game theory and a vision that pierces through the fog of the future. But here is the dark, hilarious truth. Some of the biggest empires in history were not destroyed by wars or famine or unstoppable acts of God. They were dismantled, piece by piece, by sheer, unadulterated stupidity. We are talking about the kind of decision-making that makes a toddler look like a grandmaster at a chess tournament. Imagine owning the patent for the invention that would change the world and deciding to hide it in a basement because you did not want to hurt your current sales. Imagine having the chance to buy the future of the internet for the price of a used Honda Civic and laughing in the face of the person offering it to you. This is the financial mullet in its purest form. Business in the front, absolute, chaotic carnage in the back. Tonight, we are looking past the polished PR statements and the glossy annual reports. We are diving into the abyss of corporate ego and the breathtaking arrogance of the too-big-to-fail crowd. From the king of film who hated digital photos to the rental giant who thought streaming was a joke, these are the catastrophic blunders that turned billions of dollars into a pile of very expensive ash. Grab a drink, settle in, and watch how the world's most powerful people accidentally set their own offices on fire. Every empire, no matter how grand, is built on a foundation of human ego. These corporate giants, the titans as they like to call themselves, operated under the delusion of their own infallibility. They had corner offices, private jets, and an army of yes-men whispering sweet nothings about their genius. This insulated bubble, thick with self-congratulation, was their fatal flaw. They became blind, deaf, and utterly disconnected from the very customers they claimed to serve. Take Kodak, for example, a name synonymous with capturing memories, a company that practically owned the concept of photography. Their vision, however, was stubbornly fixed on the past. They saw a future painted in celluloid, resistant to the harsh, pixelated realities of digital progress. Their dream was simple: keep selling film rolls, keep developing pictures, and keep the cash registers ringing just like they always had. Innovation? That was for startups in garages, not for a respected institution with a century of legacy. Then there was Blockbuster, the undisputed king of Friday night entertainment. Their stores were temples of cinematic choice, their late fees a predictable tax on procrastination. They believed their brick-and-mortar fortresses were impenetrable. The idea of movies delivered through a tiny internet connection, bypassing their massive infrastructure, seemed ludicrous. A joke, really. Who would want to wait for a DVD in the mail when they could just drive down the street? And finally, Yahoo. Once the internet's darling, the gateway for millions. They had the traffic, the engineers, the early lead. They were offered the chance to buy Google, a small search engine, for a pittance. They laughed it off. Later, they were offered YouTube, a quirky video sharing site, also for what amounted to pocket change for a company their size. Again, a resounding no. Their dream was to be everything to everyone, a sprawling, unfocused digital mall. They were too busy admiring their own reflection to see the asteroid heading their way. It's like a scene from a bad corporate drama. Sir, we have this new digital camera prototype. It requires no film, says the nervous young engineer to the Kodak CEO. The CEO, polishing his expensive watch, barely looks up. No film, you say? How utterly absurd. Our entire business model is film. Get that toy out of my sight and make sure we order more silver halide, Johnson. But sir, the future, Johnson, the CEO interjects, is looking exactly like yesterday, just with more zeros in our bank account. This was not just arrogance. This was a fundamental misunderstanding of progress itself. These were not visionaries. They were curators of their own impending doom. Success is a dangerous drug. It breeds a specific kind of mania where you believe the laws of gravity no longer apply to you. In the boardrooms of these giants, the air was thick with the scent of expensive leather and pure, unrefined denial. They weren't just winning, they were dominating. And when you are at the top, the only way to look is down. but they were too busy looking at their stock charts to notice the ground was disappearing. Then came the shift, the slow, quiet creep of change. A few nerds in Silicon Valley, a better algorithm, a faster internet connection. To the titans, these were just gnats, annoyances, background noise. But then, the noise got louder, the world changed. Overnight, people stopped buying film, they stopped renting DVDs, they started searching, they started streaming. The gnats became monsters, the monsters became the new market leaders. Panic, blind, sweating panic. Boardrooms turned into war rooms. Meetings lasted until sunrise. Strategy sessions became finger-pointing festivals. They tried to pivot, but it was like trying to turn an oil tanker in a bathtub. They were too heavy, too slow, too late. The mania of success was replaced by the mania of survival. "The numbers are down," screams the CFO. "Fire the marketing team," yells the CEO. "But sir, people are watching movies on their computers now," says the junior analyst. "Computers are for spreadsheets, not movies," the CEO bellows, slamming his fist on the table. "Buy more retail space. Lower the price of the popcorn. We will crush this Netflix with sheer physical presence." Staccato reality hits. Hard. No sales. No traffic. No profit. Debt climbing. Creditors calling. Lawyers circling. The stock price? A rock dropped from a cliff. $100. $50. $10. Penny stock territory. They scrambled to buy back their mistakes. Yahoo tried to buy Google later, but the price had gone from 1 million to billions. Blockbuster tried to start a streaming service, but the technology was a mess, and the customers had already moved on. Kodak filed for bankruptcy. Their patents sold for scrap metal. The mania of the rise was nothing compared to the fever dream of the fall. They watched, paralyzed, as their multi-billion-dollar kingdoms were dismantled by the very things they had laughed at 5 years earlier. The FOMO was no longer about missing a trend. It was about missing the last lifeboat on the Titanic. They were drowning in a sea of their own outdated ideas, gasping for air while the new world sailed past them without even a backward glance. Red flags were everywhere. They ignored every single one. They chose the comfort of a dying present over the uncertainty of a living future. And they paid for it with every cent they had. To understand these disasters, you have to understand a concept called the innovator's dilemma. It is the invisible trap that catches almost every successful company. Think of a giant, luxury cruise ship. It is magnificent, it is profitable, and the buffet is world-class. The captain's only job is to keep the ship moving in a straight line and make sure the passengers keep buying expensive cocktails. Then, someone spots an iceberg. It is small, but it is made of a new technology. Let's call it digital data or streaming. The captain has a choice: turn the ship and risk spilling the cocktails, or keep going and hope the iceberg is just a hallucination. Most of these CEOs choose the cocktails. Every single time. The mechanism is simple but deadly. These companies weren't stupid. They were too logical for their own good. Kodak looked at digital cameras in the 90 seconds and realized the image quality was terrible compared to film. They were right, but they failed to see that technology improves exponentially. They valued the high margin now over the low margin tomorrow. They were protecting a profit machine that was already obsolete. It is the ultimate corporate paradox. The very things that made them successful, listening to their current customers, focusing on high profits, and perfecting their existing products, are exactly the things that ensured their death. Their value proposition became a golden cage. They built a better horse-drawn carriage while the first Model T was rolling off the assembly line. "Sir, the new digital tech is cheap, and people love the convenience," the VP of Strategy explains. The CEO sighs, looking at a spreadsheet. "Yes, but our profit margin on a roll of film is 70%. The profit on a digital file is 0. Why would I kill my golden goose to sell air? Because if we don't kill the goose, someone else will come along and turn it into nuggets," the VP replies. But the CEO doesn't listen. In his mind, the mechanism of his business is a law of nature. He thinks he is being fiscally responsible. In reality, he is just signing a very expensive suicide note. They mistook a temporary monopoly for a permanent empire. They believed their value was in the product, the film, the plastic disc, the portal, when the real value was always in the service. They forgot that people didn't want film. They wanted memories. They didn't want DVDs. They wanted stories. By the time they realized the mechanism of the world had changed, the gears of their own company were already jammed with the rust of their own arrogance. They were left holding a map of a world that no longer existed. The timeline of a corporate collapse is rarely a sudden explosion. It is a slow-motion car crash that everyone sees coming except the person behind the wheel. The proof of their failure wasn't just in the declining sales. It was in the sheer humiliating irony of the aftermath. Let's look at the Netflix snub. In the year 2000, Reed Hastings, the founder of a struggling little startup called Netflix, walked into the Blockbuster headquarters. He offered to sell his company to the giant for $50 million. The Blockbuster CEO, John Antioco, reportedly struggled to keep a straight face. He thought the idea of online rentals was a niche joke. Fast forward 10 years. Blockbuster filed for bankruptcy with over $1 billion in debt. Netflix? It was on its way to becoming a $200 billion behemoth. That is not just a missed opportunity. That is a historical catastrophe. The proof was in every store closing sign that began to litter the American landscape like tombstones in a retail graveyard. Then there's the Kodak moment, the real one. In 2012, the company that had once powered the memories of the entire planet filed for Chapter 11. They had to sell off their most valuable patents to competitors like Apple and Google just to keep the lights on. They went from being the masters of the visual world to being a cautionary tale in a business textbook. The verbs of the crash are brutal: liquidated, delisted, dismantled, evaporated. Yahoo's fall was perhaps the most pathetic of all. In 2008, Microsoft offered to buy them for $44.6 billion. Yahoo's board, still high on their own fumes, said it was too low. 8 years later, after a series of desperate CEOs and failed pivots, they sold their core business to Verizon for $4.8 billion. They lost $40 billion in value by simply waiting. Sir, the bankruptcy papers are ready for your signature, the lawyer says softly. The CEO stares out the window at the empty parking lot. I don't understand. We had the best brand. We had the most stores. We had the smartest people in the room. Actually, sir, the lawyer replies, you had the most expensive people in the room. The smartest people were the ones you laughed at 10 years ago. They just bought your headquarters. They're turning your office into a server room for their streaming service. The crash is the ultimate truth teller. It strips away the PR fluff and the expensive suits, leaving behind nothing but the cold, hard numbers of failure. The proof is that in the world of business, the only thing more expensive than innovation is the cost of pretending the world isn't changing. They didn't just lose their companies, they lost their legacy. They became the before picture in a How Not to Run a Business seminar. Think about the giants of today, the ones that look invincible, untouchable, and permanent. History suggests they are just one bad boardroom meeting away from becoming a punchline. If you want to see more deep dives into the spectacular wreckage of corporate ego, make sure to let us know. The graveyard of business history is full, but there is always room for one more. The ultimate irony of these stories is that the names Kodak, Blockbuster, and Yahoo still exist. They survive as hollowed-out shells, ghosts of their former selves, or warnings printed on the first page of MBA textbooks. They serve as a grim reminder that in the world of capitalism, there is no such thing as a permanent throne. The lesson is simple, yet most people with a corner office will never learn it. Adapt or become a case study. Evolution is not a choice. It is a requirement. You can either be the one holding the hammer or the one being nailed into the coffin of irrelevance. So, the next time you see a massive company acting like it owns the future, remember the Goliaths we talked about today. They had the money, they had the power, and they had the genius until they didn't. In the end, they didn't go out with a bang. They went out with the sound of a dial-up modem, a file not found error, and a very quiet, very expensive whimper. That is the way the world ends, not with a vision, but with a no to the future.